got a couple questions I like to begin this with. Have you ever lost money in the stock market, uh, or say a 401k, a TSP, or an IRA? How much of your investment portfolio is quote unquote guaranteed? Are you afraid of running out of money in retirement? Do you wish you could pay less in taxes? If there were really a way that you could eliminate all your debts, mortgage, credit cards, etc., in say 5 to 7 years, would you implement it? And that, by the way, is the topic today. And there really is a way that you can, one, grow your money guaranteed, access cash throughout your life to pay for your lifestyle, buy assets, and is 100% tax free. Again, my name is Eric Martineau. I am a loan officer here at Nexa. That is my contact information and my calendar link. If anybody wants to get it, I'll type it into the chat here in just a minute too. Today, for the first time, I've brought somebody extra in here to help talk about getting out of debt. So we'll bring her in. But first, here's the deal with private equity banking. It is teaching you how to become your own bank. President Andrew Jackson said, "You bankers are a den of vipers." I intend to rout you out, and by eternal God, I will rout you out. If the people only understood the rank injustice of our money and banking system, there would be a revolution before morning. I don't think the money and banking system has changed much. So here's your private revolution. No need to shoot anybody. Just get out of the system and become your own bank, breaking the chains of debt, usury being high interest rates, and taxes. So that's what this system is about. We're going to show you how to eliminate bad debt. Like Mike said, asset acquisition. Well, that's good debt. Finance your own lifestyle, never pay high interest rates, and legally control and reduce your taxes. Those are the things that this presentation is about. And we now have 4 parts to it. Today's the second part of 4, but it doesn't matter if you jump in the second. Mark Twain said this: "It ain't what you know that gets you in trouble. It's what you know for sure that just ain't so." And so we're going to break some of the myths about the banking and money that just aren't so. We're going to show you how you can become your own bank. We're going to show you how you can save first and then spend money. And then we're also going to show you how you can use your money twice. And I know that sounds crazy. Nobody's heard of that before. But yes, you can use your money twice and simultaneously. So what is private equity banking? In my opinion, it's a bunch of tools that allow us to take control of our own financial situation. Here's the deal. Americans spend about 75% on debt service and taxes for every dollar that they make, right? Or for every 1,000 that we make, we spend about 340 of that on debt service. We spend about 400 on taxes. 230 goes to buy us our toys and our lifestyle, and we only put about $30 of every 1,000 away. And by the way, it doesn't matter if you're a doctor making 25,000 a month or a school teacher, we all spend about, that's the average that the American family spends. So if we wanted to look at it from another graphical way, every dollar we bring in, 75 cents is going to debts, usury, and taxes, and we're only putting 25 cents in our pocket. Well, using the tools of private equity banking, we're going to show you how you can put another quarter back up there in your lifestyle and savings and now only spend 50 cents on debts, usury, and taxes. Would that be good? Alex is shaking her head yes. What do you think, Jesse?
Yes.
All right. Well, what if I told you we could go further than that and actually get it to where it's 75 cents is going toward lifestyle and savings, and you're only spending 25 cents on debts, usury, and taxes? Would that be better?
Even better.
Even better. Okay. So if we can get you to a point where your taxes are reduced down to 20 and you've wiped out all your debt, how would you actually divide it up? In this example, because I had to put an example in, I put 40% to lifestyle and 40% to savings and investing. What would be a good one? How would you split it
I'm,
up?
I'm thinking because you said use your money twice, that you're going to tell us that you can put it all in savings and investing and somehow use the interest or something.
Wow. Okay, I'm going to have to pay you a bribe later on. That was a good answer, Jesse. I like that. No, um, you know, I would really say it goes toward investing. So, like Mike said, asset acquisition. But you're still going to have a lifestyle that's fun. But we'll get there. Great answer, though. Thank you. Now, what about retirement? And this is where it really gets cool. Because if you do this properly, you can get to the point where what you need, not necessarily what you have, because you could actually get more, because it might still be taxed because you've got, assets that are still taxable. But you can get to the point where everything you need in retirement is 100% tax-free and interest-free. And that's what I want to show you folks. Okay? In other words, you're paying zero in interest and taxes. Is this really possible? Yes, it is. And then obviously life ends, but your banking system doesn't. And what you'll end up leaving behind is tax-free generational wealth for the family, plus a family banking legacy free from usury and excess taxes. That, to me, is what's really powerful, is we can get to the point where we leave our family a system that gets them out of the rat race too. Okay, so there's 4 parts to this. Last week was part 1, and I give an overview of private equity banking. Private equity banking can help us, as I said, reduce debt service as well as taxes. And I'm going to go over this very briefly today, but this is IRS sanctioned. The IRS calls this either a cash accumulation account or a cash accumulation contract. And what you get in your private equity bank, that's what I call it when we become our own banks, is tax-free growth of our funds and tax-free use of our funds. We also have access to liquid cash at any time, no age restrictions, no fees, no closing costs, protection from creditors and lawsuits, and bank failures. Like I said, I go more in depth in this in part 1, which I did last week, so this is just a quick overview. We get guarantees on our money. Protection from an unpredictable stock market, if you will. Compound interest on all of our cash value and the dividends that we get. And then dual use. And this is a tough concept to understand. Today we're going to walk through that with some real examples. But you're going to end up with a savings account and a loan account. And they're both growing, or they're both available. One's growing and the other one you're paying on. And then you partner with, as Mike said, insurance companies that are some of the most stable companies in the world. And that's how all of this is done. And again, I go over that in part 1, which was last week, but you'll see how it works today. Part 2, as you can see her beautiful face, Danya is here with us today. She is helping me out to talk about how private equity banking can be a key to eliminating debts and excess interest. As Mike just got through saying, first get out of debt, then build wealth. So here is step 1 for most, and Danya's going to go in depth on this in just a minute. But the basic idea was summed up by Warren Buffett. He said, do not save what is left after spending. Instead, spend what is left after saving. We're going to teach people how to change that, and Danya has a software that helps people walk through this process and know how to do it. But basically the idea is we earn money and we pay taxes on everything we earn. That's the system we're in right now. Then we pay personal expenses, we buy stuff, and we save and invest. What we're going to do is break that paradigm. We earn money, then we save, then we borrow some back to pay the expenses, then we pay taxes after we've bought expenses. So we're paying taxes on a smaller amount of money, and then we buy our stuff. We all know America is in debt up to its eyeballs, $17 trillion in personal debts. As I said earlier today, this is what we're going to discuss. If I could show you how to eliminate all high interest payments and all of your debts in 5 to 7 years without earning or spending any more, would you implement the system? And that's what, again, Danya's, yeah, Jesse says yes, you like that answer. Okay, well, that's what we're going to show you how to do. Okay, in part 3, which would be next week, I've got a special guest. He was an IRS agent, and he's going to come in and talk about how to reduce and control taxation with proper business structures and income classification. As we all know, taxes depend on the type of money that we have and who gets that money. I think this was made somewhat famous when Warren Buffett stated that he pays a lower tax bracket than his secretary, and they brought him into the State of the Union address. But what he said was this: we're paying maybe 25% of our income, but the payroll tax is over a third of the receipts of the federal government. And they don't take that from me on capital gains. They don't take that from me on dividends. In other words, the kind of money that he's got is cheaper than the kind of money she makes as an employee. That's what Marvin will teach us how to do to get away from, okay? So he's going to come in and show us the types of money and the ramifications of how they're taxed, as well as the different business structures that we can get into so that we pay less tax. All right. And then part 4, again, Marvin's going to come back with me and we're going to talk about how to move as much of your money from a forever taxed environment into a never taxed environment. What that basically means, again, looking at the buckets of money, we've got a taxable bucket of money, we've got a tax deferred bucket of money, and then we've got never taxed money. And the idea is to move as much of our money throughout our lives from the forever taxed environment over to the never taxed, so that, as I showed a minute ago, when we're ready to retire, we're living on funds that are never taxed. Okay? All right. So back to part 2. Danya, let me introduce you. She's a friend of mine. She has been working with another Nexan that I am good friends with, Sharon Stewart. And I got involved in this about 4 or 5 years ago. And the reason I've never brought it into my presentation is I just didn't feel it was proper for me to bring something else in. But you know what? Every single day that I work on this, people are saying, Eric, I can't do this on my own. I need a tool. And I say, well, here's the tool. So Danya, why don't you talk about the tool you've got, please?
Yeah, hi there. Hi,
Oh, by the way,
everybody.
she's a financial advisor. Introduce yourself.
I
Sorry.
am. Please don't hold that against me. I am a financial advisor. And ironically, I kind of got out, not fully out, but out of the wealth management industry for the most part, because I started to realize very quickly that it's not truly about helping people. If you're in the industry of wealth management, it's about seeing how much money you can get people to invest. And they didn't take a look at the other side of the wealth coin that was just eating away at the possibilities of what they could do if they weren't paying hundreds of thousands of dollars of interest, right? That's a whole lot of money they could have been putting towards, growing that money for themselves. So let me go ahead and share my screen. Perfect. Okay. So here we are. So what happened was I broke out of wealth management and I decided to go out on my own so I could help people in a different way. Education was, a main focus of mine, but there's not a whole lot of money in that all the time. And also, I was part of my business was being a smart investor in the Dave Ramsey program. So when they got to the point in their program where they paid off debt and they were ready to talk to a financial advisor, I was somebody that they would call. And what I noticed was a difference of people who knew how to manage their money and knew the importance of getting rid of debt, right? They didn't unravel any kind of wealth or retirement plan that we put together. So I put that together that people needed to learn how to budget. And I wanted to educate people, but I needed to monetize it. I was looking for a tool that could help them do all of the things at once. I didn't even know if this tool existed. I found this company 9 months into my journey, ironically created by 2 mortgage brokers. They were part of one of the fastest growing mortgage companies in Utah in the 90s. And they saw such repeat business that you all as loan officers might see, which could be a really good thing a couple of times when people are coming back to refi. But then they started noticing a trend of people who were refinancing and wrapping all of their debt that they had then gone and accumulated, cars, credit cards, vacations, boats, things like that, into their home loan, to the point where sometimes they couldn't refi because of, their DTI or their credit, something like that, and they couldn't help these families. So they created this software, which they brought to market. And I'm going to show you how the debt piece can help you quickly eliminate your debt. But we can also implement other tools with it so that you can use the same dollar to do 2 jobs. So watch for that during this as well. Okay. So here we go with the MoneyMax account. What this does is I'm going to show you how the breakdown of an amortization statement works, right? You're all in the industry, so you know what an amortization schedule is. But let's look at this with a magnifying glass. So if we have a $200,000 mortgage at a 6% interest rate for 30 years, the payment is going to be $1,199.10. We knocked the 10 cents off just so it looks better on a slide, but it's still calculated in there, okay? So the very first month on this 6% loan, you're going to pay $1199.10 to the mortgage company. $199 goes to principal. $1,000 goes to interest, right? We don't have to be math geniuses to see that that's not 6%. That's actually 83% that we just paid in interest, all right? but that's okay. Don't get disgusted yet because it does get better in month 2. All right. So in month 2, you pay $11.99.10 and $200 goes to your principal, $9.99 goes to interest. So that is $1 better. I have no idea why it takes 30 years to pay off this mortgage, right? So let's continue to look, and I want you to look at the total paid column versus the equity column, okay? So let's go to year 5 here. Year 5, we've paid in a total of $71,946. Yet, we only have $13,891 in equity. That's crazy, right? How is that? Why is that? Well, that's because we've paid $58,000 in interest so far. That's why. It's really hard to build up an equity position if we're going at this rate, right? So same thing, check out the total paid versus the equity column. And here we get to year 21. So in year 21, on this $200,000 loan so far, we have paid $302,000 towards this loan. And we have just reached the halfway mark of paying down the principal of this money we borrowed, right? We're just now under $100,000. So let's go to year 30. Let's say we follow this loan all the way through to the end. We don't refi, we don't do anything. We are going to pay $431,000 on a $200,000 loan. That's 115% interest. That's crazy, right? That is not 6%. It's nowhere near 6%. It doesn't look like 6% at any time, right? This is what we like to call legalized extortion right here. 115% sold as 6%, right? Okay. But we can get a better interest rate, right? It's all relative. Let's say we get a 4% interest rate on a $300,000 loan for 30 years. It's the same thing. Check out in year 1, we're still paying 69% interest. That's nowhere near 4. Year 5, we're paying 63. Year 10, 55. And in year 15, we are still paying 45% interest on this loan. No wonder we can't get ahead. And I don't know if anybody's ever heard this, and I don't speak French, so I don't know if it's true, but the word mortgage actually means pledge to death. That's why most of us, most people will die with a mortgage. It's because it's intended for you to pay until you die. So we have created a better way. It does not have to be like this. So let me ask you a question. Anybody and everybody, feel free to answer. Is it smart to borrow 10% money to pay off a 6% debt? Would you ever do that? Would you say, hey, I have this 6% loan. I'd like to borrow some money at 10% to pay on it. Would you do that? Would anybody do
Oh, don't leave her hanging. Somebody.
that? That's okay. Heads were shaking. It's okay.
Heads are shaking.
Absolutely not.
Okay.
So okay, in a normal day, we would say, no, that makes no sense, right? I even hear, I was telling him, financial professionals say, well, I don't want to pay off my mortgage early. That's the cheapest money I'll ever borrow. And I have to do that because it's not, as you all just saw, right? So it can be smarter to borrow 10% money to pay off a 6% debt, depending on the type of interest of the money you're borrowing and the type of interest of the debt you're paying off, right? That does matter. There are different kinds of interest, as we well know. So let's take a look at this scenario of 10% and 6% money. We're going to look at the same loan of 6% amortized interest, which does make a difference. And what we're going to do is we're going to spin this scenario. We're going to get a loan. We're going to call it any type of loan. We can call it a HELOC, a line of credit. We could borrow from a credit card. We could borrow it from your parents at 10%, but we just want to get 10% money from somewhere, okay? And what we're going to do is we're going to borrow $1,010. And the reason we're going to borrow $1,010 is because we are going to pay our first mortgage payment here. Well, we're going to add up with this principal cost for the next 5 months. And the principal is going to be $1,010. What I want you to do here is really pay attention to the relationship between the principal and the interest of this loan. So if we want to get ahead, we're going to pay $1,010 towards the principal of this loan. And what that does is it cancels out the interest for October, November, December, January, and February of this loan, right? So it cost us $1,010 that we borrowed at 10% interest. If it takes us a whole year to pay it off, we're going to pay $110 in interest. But what we've done here is we have saved $4,985 off the back end of this mortgage, right? So now I'm going to ask you the question again. Would you spend $1,000 to save $5,000? Right?
Yes.
Most people would, right? Without question. It's not even a question. It's math. It makes sense. Okay. So this is what we call velocity banking, right? Velocity banking is fantastic. Go ahead, Eric.
Okay, so my wife and I, when we were young Marines, we decided that we were going to retire buying real estate. So we got into real estate, and back in the 90s, velocity banking was all the rage. For those of you that are loan officers, how many of you know about the CMG loan? Alex does. Jesse, have you heard of the CMG loan? Mauricio?
No.
Okay, I'd suggest, yeah, just write that down on something. CMG. Go look them up on the loan officer support page. They're a fabulous program. What's that, Sharon?
It's the all-in-one. The all-in-one.
Yeah, it's the all-in-one loan. Yeah, CMG is the name of the. Yeah, CMG all-in-one. Thank you, Diane. So I got exposed to that and said, wow, I want to do this. Anyhow, with that loan, could you click on that for me, Danya, since you've got the
Sure.
control there? Yeah. So because I understood the CMG loan, when I heard about private equity banking, what it is you use a mutual insurance company to do the same velocity banking, but a lot quicker. And this is where you get your two accounts. You've got your money sitting in there guaranteed at, say, 5%. And the reason I've got an about there is because there's 4 or 5 companies that you could do this with, and they're all right around that area. And that they'll give you a loan at about 6%. So instead of paying, like Danya just explained, 10% for a line of credit, now you've got a total cost of only about 1%. So what you're doing is you're lowering your cost of capital by about 90%. Click on that next one for me. So that's why I got involved in that. Because now instead of paying 110, we're paying $11, and thus lowering my cost of capital by 90%. So if you think about all the things that you could do if you were lowering your cost of capital by 90%, there's a lot. And so it gets you out of debt quicker. I'll turn it back over to you, Danya.
Awesome. Awesome. Okay, so now back to the software that I came across. What this does is it causes every single dollar that you make to either earn interest or to cancel interest, right? And this is important, and we'll show you why. So we're going to go through. Now, the minimum requirements to use this software are pretty simple. You've got to have debts. Does anybody on here have debts?
How about you ask the negative?
Okay.
Anybody not
Couple
have
people.
debt?
A checking account. You have to have a checking account. You have to have a savings account. This program can operate solely out of these 2 accounts and still eliminate your debt insanely fast. Probably 5 to 10 years is our average. And then you need the software for this to work, okay? Now, optionally, and it works with all of these, you can get a line of credit like we were talking about. It can be a HELOC, a personal, a business line of credit, a loan from somebody you know. It doesn't matter. And then the open-ended lines of credit, like this supercharged velocity banking, right? Which this high cash value life insurance or cash accumulation account. And what an open-ended line of credit does is the principal balance and interest adjusts every single time a payment is received, right? So it's calculated daily, unlike our closed-in lines of credit, like our mortgage, and that's why these work. Okay, so let's take a look at this. We're going to look at an example of John and Rebecca Jones here. Now, here's an example of their income is $5,000. Their expenses are $4,800, which leaves them only $200 a month in discretionary income, right? A normal person looks at this and says, well, shoot, how can I eliminate all of my debt quickly with only $200 extra per month? Well, I can try to pay this off, do that. We don't do that. So we're going to look at this from a different perspective. Let's look at the same $200,000 loan at 6% interest. And they also have an auto loan here, right? At 7.5% interest, with 60 months left on it. They have a credit card with no balance right now. Okay. So we're going to look at the program. The software utilizes 8 banking strategies that the banks have been using for years to make money off of our money. And so what we're going to do is show you how to become your own bank. And then I will add in the private equity banking to show you what that looks like with that. Okay. All right. So we're going to first look at month 1. And what happens is John and Rebecca get their paycheck of $5,000. It goes into their checking account. From their checking account, they're going to transfer it over to their private equity banking account. Okay. So what happens is now they have $5,000 in cash value in there. They're earning interest on this at 5% approximately, right? What they have also created by doing this is a line of credit for themselves. Okay. Now, what they're going to do is they're going to pay all of their bills on their, let's say, credit card. We know you can't pay a mortgage on a credit card. And this is where, the difference between a line of credit and something else will come in here, like the private equity banking. But let's just say they pay all of their $4,800 in bills on their credit card this month. All right. So what happens is they pay their mortgage. So that goes down by $199. They canceled out in interest, right? Or in principal. Now, they've earned interest on this $5,000 they've put into this account, right? That's interest accumulation. So that's your money earning money. Even if it's only $21, your money is working for you at 5% interest, okay? So interest accumulation. Now, let's check out in month 2. They get their paycheck. It goes into checking, $5,000. Now, we have floated the interest on this credit card for 30 days. We borrowed money because we put ours in here to earn interest. We borrowed money for free over here, right? So now what we're going to do is we're going to pay that off so we don't have to pay the interest. So we put $4,800 onto that card. It's paid off. That leaves us $200 in the checking account. Now, we're going to transfer, we're going to borrow from our line of credit that we created from private equity banking, $3,789 and put it into our checking account. Okay. So now we have $3,989. Now, here's what we're able to do with that. Look what happened. We have $5,021 because we earned that 5% interest, right? So that's $251 annual interest that we earned, and about $21 a month we would earn on that $5,000. Now, we're going to take out this loan from our line of credit that we created in private equity banking of $3,789. Let's just say it's around 6% interest, which is $227 annual divided by 12. This is going to cost you about $19 a month, right? So you are in the positive $2 to earn this, to take this money to float interest from your line of credit that you created. Now, we're going
Can I
to
make a comment there, Danya?
Oh, yeah. Go ahead.
So that's, Jesse, that what you asked about, having your money using it twice, that's how it's working. You notice that the cash value side never went down. It stayed. That 5,021 is still sitting there, and you have now a second pot of money where borrowed less than that of 3,789. That is the magic that a private equity banking account can do that none of the other loan lines of credit are capable of doing. Sorry for interrupting you, Danya. Keep going.
No, that's perfect. That's perfect. That's worth saying again, and then noticing that you also earned $2.
Yes, between the difference. Mm-hmm.
Being able to do that. Yeah. So now we're going to take that $3,989 and we're going to apply it to the mortgage principal. Okay. That drops us down to $195,812. Obviously, that's math. But what we really did right there in month 2 was canceled $18,000 of interest and eliminated 18 payments on this mortgage just by making that one move. Okay. So that is our third banking principle that we utilize is interest cancellation. Now in month 3, we know the drill. We get paid $5,000 to checking. We move that money now to our savings or our cash value account in this private equity banking. That brings our total to $10,021 and our line of credit increases to $10,000, right? So we've earned another month's worth of interest on here. So we're now up to $10,063 because this is earning compound interest. We're going to go ahead and put all of our expenses on a credit card or a line of credit. We're going to float that interest again for 30 days, right?
Repeat,
So let's take a
rinse and repeat, right?
exactly. Just continue to do it. Yes.
Okay, got it.
And what happens after we just did that in the second month of this mortgage? We did that. They only had $200 of discretionary income. Imagine if they said, I'm just going to pay $100 extra to my mortgage every month, right? That's what we hear. That's what realtors, loan officers say. Well, if you just do biweekly payments, that takes 7 years off your mortgage. Truth, that does. But we can do so much better than that, even if you don't have a lot of money to throw at your principal, right? There are smarter ways to go about this. So by applying that $3,989, we brought our balance from $199,000 to $195,000. We brought our payments in the amortization schedule. We're at $358 in month 2, but we brought it down to $340, eliminating 18 payments. The interest we were scheduled to pay was $231,000. We brought that to $212,000 because we wiped out $18,000 in interest. How incredible is that in the second month of your mortgage? Second month, I love it. Okay. So another tool or a way, a strategy that the program helps you with is strategic payoff, right? Because I would love to think all of us are just walking around with our mortgage and that's the only debt we have. And all of our clients only have one debt, but that's not the truth. We know it gets messy out there, right? So we have, let's say, typically a mortgage, an auto loan, maybe some student loans, a couple credit cards, maybe some 0% or some furniture at 7%, right? How do we know which one to pay off first? I mean, the calculations, and I've seen them. I have really smart engineers as clients who bring me Excel sheets. The calculations are in the hundreds every single month to find out which one is the most strategic one to pay off first. This is not something that you and I can do, even if we're really good at math. So the program helps you to decide. And we've seen all of the, I don't know how to get back in this, Eric. How do I do? We've seen all of the things. How many of you heard of the debt snowball? Anybody heard of the debt snowball?
Yep.
Or the avalanche, right? There's all these strategies or methods out there. But guess what? None of them are based on math. Not one single one of them are based on math. They're all just strategies. And so you can use any of them or none of them, but the software helps you to make the most strategic move because it guides you every step of the way and it tells you which one is the most strategic to pay off first. So you don't have to guess at it. Okay, so looking at this right here, we saw the starting balance of their mortgage. They had 30 years left on it and they were scheduled to pay $231,000 in interest. Well, with the system, we had their mortgage and their car debt at almost $9,000. They're going to be debt free in 14.9 years. Remember, they only have $200 of discretionary income per month. They're still going to cut half the time off of their loan, all of their debts, and they're only going to pay $109,000 in interest. This means that they're saving $123,000 in 15 years. I mean, think what they can do with all that extra time and money. They can pad their retirements or, a whole host of things they can do. Okay, so obviously, who's there to lose? The debts. So we have eliminated to date over $2.5 billion in debt. We're eliminating $13 million in debt every single month for our clients. And this works just like a GPS. It is constantly recalculating. It's millions of lines of code, it's algorithms, and it takes every single aspect of your financial situation into account. So if you have multiple streams of income, if you're commission based and your income fluctuates, sometimes dramatically, how much do you owe and for how long? What kind of interest rate is attached to that debt? Is it fixed? Is it adjustable? Is it simple? Is it amortized? Is it compound? That makes a huge difference. It anticipates what's coming down the road. So vacations, holiday spending, tax returns. If you pay your insurance by semi-annually, right? If you pay it twice a year, or if you have just those annual expenses that sneak up on you, if you have your auto registration due once a year that sneaks up on you, something like that. It calculates all of that. Today, it's calculating. It knows what's down the road, a year, 2 years, 5 years from now. Also, because unexpected expenses are always happening, right? Medical bills, vet bills. If you have kids, kids are expensive and things come up all the time that you did not anticipate,
You
right?
figure?
So
Kids are expensive? Why didn't you
they're
tell me
so
that 30
expensive.
years ago? Oh, sorry, I shouldn't interrupt.
No, because then you wouldn't have done it. You would have been set on the best thing you ever had. You wouldn't have
It
done it.
never ends.
It never ends. Yeah, grandkids are expensive too, Danya.
Yeah, but that's more by choice, not by
Yeah,
force, right?
yeah, yeah.
Yes. So that's always coming up. Something is always going to break and something is always
Yeah.
going to cost you money. And that's what the program does. It's just constantly recalculating for you. It says, it's okay, you got this. I mean, I can tell you my nightmare rental stories. They don't compete with Eric's nightmare rental stories, but I would have jumped out of my property in a quick minute. Had this program not told me, it's okay, girl, you got this. Floods, no renters, everything, you've got it. And I did, I kept it, and it's been good. So what the program does not do is it does not move your money. It does not pay your bills. You don't have to put any account numbers or social security numbers in. It doesn't, nobody has access to your money. It acts like an account register. It's like a supercharged, I guess, checkbook register. I know nobody uses those anymore, but it's pretty fascinating. It just wants to know how much money is coming in and how much money is going out. It tracks and it maintains your monthly budget so that you're not in budget jail by any means, but you get to prioritize what's really important to you and put in those things. Put in, if you'd love to travel, Sharon, put in those trips, budget for what's really important in your life. We want you living life. We don't want you living to a budget.
Mario has a question.
Oh, okay. What is that?
Yes. I just want to make sense in my mind. Looks a little bit like if you had stocks like a margin account, but to make sense for me, it's like having on the savings accounts having two lines of credit and just trying to pay more of the monthly payments so you can lower the amortization, like the time to pay it off.
Sure. So let me simplify it and try to make sense of it for you. So let's just talk about using just a checking and savings account, okay? If you just had a checking account and a savings account, what the program does is it will instruct you if you have extra money because you spent less on your food budget or you got extra money in commissions, something. It says, put this in savings, put this in savings, put this in savings. It saves up to a strategic dollar amount, which we have no way to predict what that is, but it knows what your payment due dates are, what your interest rates, all of that. It knows when you're making your regular monthly payments. And at a certain point in time, it will say, now take this amount of money to the penny, right? Like we saw in that example, it was $3,789, right? No rhyme or reason to that, except the algorithm knows to the penny. Now take that out on this date and pay it to this debt. And so it's saving up to maximize eliminating interest on that debt strategically, right?
Danya?
It doesn't make sense in our heads. Yes.
Okay, I want to make a comment there. And by the way, folks, this is why I got involved with this. Diane and I, when we were Marines, our goal was to have all these houses and retire at age 45 and then live off of the rents. And we had about 16 properties, if I recall correctly, rental properties when we finally got out of the Marine Corps. That was our goal. We had them on shorter mortgages to get them off. And at the end of each month, she and I would go through our check register and say, okay, we got $400 left over. And we would just choose one of the mortgages and we put the 400 there. Or we've got $150 left over and we put it there. What we didn't have was a reserve. So you just said, Danya, well, we don't know where that magic number is. But the software does allow us to save, I want a reserve of 5,000, 10,000, 20,000, whatever. And then it leaves it in the savings because I was working for AT&T and got laid off. We had all those mortgages. They were underwater because I was stupid, and I won't blame it on my wife. It was me. I was stupid enough to put them all on 10 and 15-year mortgages, and the rents didn't cover the mortgage nut. There wasn't a single lender, you all know this, that was willing to give me a loan when I got laid off, and there was none of them that would give me the 9 months I needed in leeway to go back and get another job. It wasn't that I wasn't, capable. For heaven's sakes, I had 2 master's degrees. I was a hireable person, but I didn't have a job for 9 months, and we were underwater. And so I kind of shied away from Velocity Banking after that because I had been just throwing in every penny that I made at the end of each month because that goal was to have everything done by the time I was 45. And if I had had the software and had listened to somebody like Danya, I would have gone, okay, my goal is not to lose a job and lose everything over a 9-month period. I need to make sure that I put away a certain amount. And the software does allow you to do that, correct? I know it's correct because I've got the software, but correct, Danya?
Yeah, that is correct. I mean, it allows you to program in anything your heart desires that we can mathematically program in. So if you want the reserves, we can put the reserves. And that's simplifying it with just the checking and savings, right? When we get into private equity banking, I mean, it's basically doing the same thing. We exchange that for the savings account, and then the private equity banking allows us to do double duty by creating not only a savings, but also a line of credit. Okay. Does that help at all with your question?
Yes, and so the line of credit that comes from you guys or from the company?
So
bank,
not
usually.
the software is just the software, it's just the GPS, and it will work in conjunction with just the checking and savings account, or like I said, any line of credit or the private equity banking. And the private equity banking is something that Eric does. So you can talk to him about the private equity banking. Yeah.
These are, again, this is now going to be a 4-part series, and I want everyone to understand every one of these parts can stand alone. You don't have to go get a private equity banking account to do what Danya's doing. There is no reason why we can't give tools to our clients that'll help them get out of debt. We all have had people come to us that aren't at that 34% DTI, which is the American average. They're at 65 DTI and they're barely making it. That's why I liked your example, Danya, of somebody that only has discretionary income of $200, and now they've gone from being in debt for 30 years down to 14, even though they only had $200 in discretionary income. These tools can help everyone get out of debt quicker. Sorry, I took your thunder there, maybe.
No, you're fine. No, I have lots more thunder, Eric.
Okay.
We're good. So
it isn't even monsoon season.
I know. I just carry it around with me. So what it does in summary, it helps you eliminate all of your debt in a fraction of the time. It helps you make educated financial decisions rather than just guessing. We all do the best we can with what we have, but we're mostly just guessing, or we heard somebody on the radio say it, or our neighbor. And actually, most people on a regular basis, what I deal with clients in my financial advisor business is the psychology of money, which is mostly actually emotional decisions, right? We do it based on fear, guilt, and shame. We don't want to be broke. We don't want to be this, or we don't want to, we didn't get this, or we deserve this. All the things, right? And there's no math involved. Every conversation I have, there is zero math involved. It's all feelings, which is okay because the program brings the math to you. You can feel all you want, and let's put the numbers in there. And if you don't like the number that it gives back to you, well, then you can adjust those feelings a little bit, right? And it's been amazing for helping people with that. And in many cases, it improves credit scores. So actually, that's how Sharon and I started working together. Is She said, well, let me send you a few of my clients that maybe don't qualify because they have low credit or they're DTI or, for whatever reason. I said, okay, great. And by default, by helping them with their money and redirect it to all the right places, it helps improve their credit scores. You own this program for life. Once you own it, it is yours. You can use it on multiple properties. It is amazing for real estate investors. Like I said, I have a rental property now that I actually wasn't even planning on getting. It just fell in my lap. And I said, well, why not? I have the program. But I have like a gentleman in Georgia who is killing it. He has $3.5 million portfolio. He's got 11 mortgages. He's got some paid off properties, but he's just killing it with this program. And he is going to be debt free in 14 years. Bringing in $28,000 of income from this $3.5 million portfolio. So retirement looks a little bit better than he thought it did now. No mandatory monthly fees with this program. Contracts are surprises. There are free updates. And as a matter of fact, we just came out with one last week that was pretty phenomenal. They're always working on the algorithm. They have full-time IT staff working on the algorithm, always improving, implementing new features for us. And there's always live customer support and coaching for the program. So if you'll, Eric, put the scheduling link in the chat box. I do have a link that you can schedule with me. I'm booked out. My next availability is next Tuesday, but it is free. If you want to run a savings analysis on your own debt, we look at your debt, income, expenses, we put in the program and we find out what your debt-free date is, what that looks like, how much money and interest it can save you. If you look at the highlight reel here at the bottom, it will tell you debt-free in 14.9 years by this month and year, savings, how many years it's going to save you, and then total interest savings in dollars, and then average savings per month. And it's free to do this. And as to what Eric was talking about, that Sharon started sending me clients and of clients that she meets who she's able to help get into a loan. She's like, here you go. I helped you. I worked really hard to help you get into this new 30-year prison. But here now I have a program that can help you get out of it very quickly and all of your other debts. So she sends me a lot of her clients. It's been so helpful. I mean, we've met and made the most amazing friends through being able to get to know these people. But more so what we've done for her is we've been able to open it up for her to have more business from her clients. So for those who don't qualify, we're able to quickly get them to a point. It might take 6 or 12 months, but we know when they're ready to qualify, they qualify, right? And they're solid. We know that. It helps her people that she's able to get a loan. It helps them build up an equity position 7 times faster than they normally would. So you know what happens when they build up equity faster is that they either want to upgrade their home, or they want to buy a rental property, or they want to buy that vacation home or that second home somewhere, and they're going to work with you again sooner, right? Also, and I'll answer your question in just a second, Jesse. So also what it does is, if you're helping them get into their mortgage and then you're helping them get out of their mortgage and all their debt quickly, what they're going to say as soon as their cousin or their neighbor wants to buy another home or do something, they're going to say, you have to talk to my mortgage broker. You have to talk to my realtor because they helped me get into this home and they also helped me get out of debt fast. You've got to use them. So it increases your referral rate as well. And it really makes them sticky and loyal to you because they log into this account every day and they're thinking of you as they're, hitting their milestones and making progress in their financial life. Yeah, absolutely. I love that. And it's a really good solution. And it's not even just a quick solution. It's a permanent solution for the rest of their life. It changes lifetime financial trajectory. So we stop talking about survival mode and we start talking about wealth transfer at some point with people. We get to turn it into more.
Yeah, that's exactly what Mike said at the beginning of this presentation, right? Debt elimination is great, but get out of debt and then build wealth. And all these tools do both of those. They help get out of debt and then they also build wealth. Yeah.
100%. I want to jump in real quick. Sorry, I got my granddaughter here, but some of the ones that Danya, there's been multiple times where I've said, Danya, we have a kid, I don't know, from years ago that went on the program. He's just got a little too much debt, didn't do anything else, didn't do a loan yet. He's on the radar. We had one girl, Jen, who called me to do a refi. And granted one that were in the mortgage business. However, in her case, it just did not make sense. And so when I showed her this program, pushed over to Danya, it completely did not make. Sometimes it just doesn't make sense, and we already know that. And so I'm not going to do something that doesn't make sense for someone. So she ended up, and now she's doing the program.
But she
We
got the
also did-
software, and that did make sense. Is that what you're saying, Sharon?
Correct, yes. And now she's doing it. She's referring people to them too. And then we had another one I was going to do a reverse mortgage for, and it just didn't shoot. They were too young. They're babies. They were 62. House was
Babies.
right at the 51. Baby reverse, right at the halfway mark. It just didn't make sense for them at that point for what they wanted to do. So that's what I got another option. Then we started looking at this. She went over to Danya. We've got a way to, they're going to be able to pay their debt down this fast. And then in another few years, it's on plan that, okay, now let's do that reverse. They wanted a chunk of change. And at 62, you're not going to get a chunk of change. So we'll get to that point. We're like, okay, now get your chunk of change, buy your RV and go for the world.
Right.
So there's something for everyone.
By the way, Sharon,
What?
she's
You pay
killing
off?
it. She's gonna be debt free in less than 1.9 years.
Oh my gosh.
Yeah,
See,
she
so
is
we
doing
just went
amazing.
from a 50% mortgage to a 0 balance mortgage. You want to do reverse with that? I'll do reverse all day on that one. That'll be fun. If they even do it, I don't know. Regardless, I was able to help people when I couldn't help them with a mortgage. Yes, and it's so.
Yeah. If you click on the next slide, Danya, this is what Mike said to me. Click through the whole thing. He said, Eric, problem with loan officers is we think that we're transformational with people's lives because we help them get a home. The reality is we're transactional. But if you can help people get out of debt, now you've become a transformational person in their life, and they will stay with you. So that was why he had asked me to, play with this also.